this lecture, we're going to talk about deferring income and scheduling income as a technique, as a legal way to avoid capital gains taxes. One of the oldest legal tricks in the book to lower and even avoid capital gains taxes is to defer and or schedule your income. Now, you can only do this when you have control over your income. The basis of this technique is easy. You simply avoid and or schedule taking lump sum cash payments for assets that you have sold. Savvy taxpayers oftentimes will owner finance a large business asset that they are selling in order to only pay taxes on the total payments, including principal and interest, during the year. These same savvy taxpayers use these types of self or owner financing to generate a large cash flow over a set amount of years with a stiff repayment penalty included in the contract. Now, the prepayment penalty will offset additional taxes that would be owed if the buyer pays off the mortgage early. An example is you own a condo in New York City that you have rented out as a vacation rental for 20 years. You now want to do something else in life, something different, like quit your job or retire early. You see, the New York City condo, you're going to sell it for $5 million US, but you don't want the new owner to finance the property or use his or her bank. You want them to pay you on a monthly basis. There is no way that you want to show $5 million on your tax return, even if you have to pay some of that $5 million to pay off the mortgage. Your tax return would look a lot different if you only received 12 payments of $22,452 at 3.5% interest for 30 years, rather than a $5 million lump sum. And this is based upon you owning the New York City condo outright. You paid for it over the years, or your rentals have paid for it over the years. In this example, you want to live off of the monthly payments and use your 401k to start a business that you have researched and you feel confident that you can make this new business work. Still, you don't want to worry about money or finances, and you never, ever want to return to work. And you need enough monthly income to maintain your lifestyle. You would receive approximately $269,424 a year under this arrangement. Now, using this type of tax planning, you have gone from a $5 million being taxed on $5 million to being taxed on approximately $269,424. This is how the wealthy just wipes out capital gains taxes, and you can do the same. This type of transaction not only lowers your taxes, but provides a steady cash flow for 30 years. But you really don't want the buyer to refinance the property all of a sudden, and there you're sitting with like $3 million. So you want to have a healthy prepayment penalty within the contract, and you want to keep the rate low so that the buyer won't want or won't feel the need to refinance the property. All it takes to implement such a plan is to tax plan your way into a monthly income from your real estate investments. Maybe it's always a good idea when you're in this type of situation that you owner finance, that you become the bank rather than the customer.